Good day. My name is Emmanuel Boamasafu, and I'm here to present on the topic the strategic implication of artificial intelligence adoption in the banking industry. And the industry, out of the banking industry, the bank that I chose is EcoBank. So first of all, I would like to talk a little bit about artificial intelligence and how the adoption came in and then how it is impacting on the banking industry and EcoBank to be specific. So first of all, artificial intelligence refers to the technologies that automate processes, improve decision making, and personalize customer services. In strategic management, AI is a disruptive technological force that changes competition, costs, and customer expectations. Examples of AI include the machine learning, data analytics, automation tools, and generative AI. So, I would like to speak a little bit about the artificial intelligence. Artificial intelligence has become one of the biggest external changes affecting businesses today. Its growth has increased rapidly after tools like ChatGPT were released in 2022, showing how technology can improve everyday work. Many organizations now use AI to automate tasks, reduce costs, and make better decisions. AI is changing how companies compete and serve customers. Because of this, businesses must adjust their strategies to remain in the competition. Okay, so I'll move on to the major external environmental forces. So, talking about these points that I have stated here, so by the year 2025, about 78% of organizations were using this AI in at least one business activity, showing its global importance. In banking, large investments in AI help automate operations and reduce costs, obviously, and improve efficiency. AI also improves fraud detection by analyzing transactions quickly and identifying suspicious activities. So banks use AI to personalize services and recommend financial products to their customers. So in Africa, Ghana to be precise, the AI adoption is growing, but challenges limited. But there are challenges that is limiting the AI from being implemented in. Some of the challenges are the infrastructure and the skill knowledge. Okay, so I'll move on to the industry level impact, that is using the pestle analysis, which is the political, economical, the social, the technology, the legal, and the environmental. So first of all, how is this political factor affecting these industries? The government policy and regulations influence how industries operate and compete. So stable political environments encourage investment and industry growth. Taxes, subsidies, and central bank policies can affect possibilities. So political decisions can either support or restrict industries. Therefore, government actions strongly shape industry success. Okay, so I'd like to talk about the economic part also. So the economic factor conditions affect customer spending and business cost. Inflation increases production expense while interest rates influences borrowing. Economic growth increases demand for products and services. During recession, industries may experience reduced sales. Overall, economic trends determine industry profitability. And also, we'll move on to the social factors. The social trends include the lifestyle of people, the changes in the lifestyle of people, the culture and population characteristics. Changes in customer preferences creates a new market opportunities. So younger population increase demand for digital services. The social behavior influences the types of products companies offer. Industries must adapt to changing consumer needs. And also continue to the technology part, how the technological factor affects the industry. So the technology changes how industry produce goods and deliver services. Automation and AI improve efficiency and reduce operational costs. New technologies can disrupt traditional business model. Companies that adopt innovation gain competitive advantage. Technology often creates entirely new industries. That is for sure. I'll move on to the legal factors. Legal rules determine how businesses must operate. So compliance with laws increases operational costs but protects consumers. Data protection and labor laws influences company practice. Regulation can limit or guide industry behavior. Firms must follow legal requirements to avoid penalties. That is for the legal part. And then the environmental factors is also concerns focus on sustainability and climate impact. Industries must adapt to eco-friendly practices due to regulations and consumer expectations. So climate change affects sectors like the agriculture and energy. Green technologies are becoming more important. Sustainability now influences long-term industry strategy. I would like to emphasize also on the Porter's five forces. So these are the 5 forces of Porter. That is 1. The competitive rivalry. I'd like to start from the bottom. So the competitive rivalry. So this refers to the competition among existing firms in the same industry. When many companies compete, profits usually decrease. Businesses may lower prices or increase advertising to attract customers. High rivalry makes it harder to stand out. Strong competition reduces industry profitability. And also the threat of new entrants. So I think this shows how easy it is for new companies to enter the market. Low barriers like small setup costs increases competition. High capital requirements or strong brand loyalty make entry difficult. Easy entry reduces profits for existing firms. Industries with barriers are more protected. I'll move on to the bargaining power of buyers. Buyers have power when they have many alternatives. Customers can demand lower prices or better quality. So easy switching between providers increases buyer influence. Companies must improve values to retain customers. Strong buyers' power reduces company profit. Bargaining power of suppliers. That's next point. The bargaining power of suppliers. Suppliers have power when few alternatives exist. That is, they can increase prices or reduce the quality. So business depends on a specific supplier face higher costs. So strong supplier power weakens company bargaining ability. And firms try to diversify suppliers to reduce risk. And then the last one that I will talk about is the substitute threats or the substitute. So substitutes are alternative products that satisfy the same need. When substitutes are unavailable, customers can easily switch. This limits how much companies can charge. So businesses must innovate to remain attractive. So high substitutes reduce industry profitability. That is for the Porter's 5 forces. Then again, I would like to move on to the firm's level analysis. So in the analysis, we have the AI credit scoring systems, fraud detection tools, cloud migration, and then the Hawk AI monitoring. So in simple terms, Ecobank has actively adopted AI to improve its operations and competitiveness. The bank uses AI for credit scoring and risk management to make better lending decisions. AI fraud detection systems help improve payment security and customer trust. Digital transformation and increase mobile transaction and operational efficiency. These improvements contribute to higher revenue and profits growth. So I would like to move on to the next place. So I'm going to move on to the strategic evaluation, and then I'll move to the recommendations as well. So Ecobank's strategy can be explained using dynamic capabilities. The capabilities theory. The bank first identified AI opportunities, then invested in AI technologies. It also transformed operations through cloud migration and digital platforms. And also, challenges include skill shortages, cybersecurity risk, and regulatory differences. Recommended actions include developing AI talent, improving governance, and expanding inclusive digital finance services. Thank you.